Hello, everyone, and welcome to this MCT industry webinar on election volatility preparedness. Um, you're joining our first webinar that we're doing using the Zoom platform. So thanks for riding along for our test session here and being one of our guinea pigs for this new platform. We're going to be using this for our MCT Exchange conference, and so we're getting some valuable experience using it here today. So that said, we're new to it as well. You guys should have a pretty normal webinar experience as usual. You've got the chat function that you can use to submit questions. We'll keep our eye on that chat section, and we'll answer those questions as we go along. And we'll also have a Q&A section at the end. As we typically do, we'll be recording this webinar, and we'll also be sharing the recording and the slide deck in a follow-up email that will go out this afternoon. So with that, I will turn it over to Phil Rizzori to kick things off.
Well, thanks, Ian. Appreciate everybody getting on the call. And like Ian said, this is the second part in our election volatility preparedness webinar series. So for the clients on the line, this will be definitely a review with obviously update on kind of where we see things. I just wanted to just make a couple of comments first. This webinar will be like the last one, where Bennick and Andrew Rhodes will take the majority of it, and then we'll follow up with a demo of some MCT Live functionality with Paul Yarbrough. Just a couple of comments. I think first of all, and Ben will talk about this at length, but as there's been probably a little bit more of a coalescence around a theory of what's going to happen in the election, and maybe thoughts of less of maybe a contested result. That definitely could. Should that not happen, you could make the case that we're in a position now versus 3 weeks ago where the market was preparing for a volatile result. We're in a position now where the market's not quite as prepared, not quite preparing as much for that. Definitely should it happen, you could make the argument there would be a lot more volatility. The other thing I think that you're seeing now in the 10-year, Andrew will talk about this in more detail as he goes through best practices. But with the 10-year rising, obviously the Fed's holding mortgages tight, but you're definitely seeing a little bit of a tick up here with a potential of maybe a last-minute stimulus that's pushed through. So that's so again, I think at the outset, there are some customers, lenders really across the country who, I've seen kind of looked at the story and said, look, the only risk we see would be a downside in rates. We really don't see rates rising. So there are some lenders who are, some substantially underhedged and some just mildly underhedged. And again, going into any period where you could make the case that there's going to be volatility, we would plead with those lenders to get to an interest rate neutral position. And the last thing I'll just say, and again, Andrew will touch on this, but one thing that has come up since our last webinar, which we did bring up, but as some of you who are out of trading capacity, given your volume, as some of you begin to move to best efforts, some of the investors have noticed that, which is completely fine, but they've been reminding you all and us as well that they are going to be looking those loans up on MERS, and if they're flipped, they're going to, at least they say they will be charging. So that's important for us to drive home. But with that, I'm going to pass it to Ben Nicken, and he can get us started on where we are in the election and how it could affect the market.
Thanks, Phil. Can you guys hear me?
Sure can, Ben.
Yep.
Perfect. So a little bit of a repetition from what we did a couple weeks for our customers, and I know we've got some folks on the line that aren't from the customer base. So try to shift it around a little bit, but the message is still kind of the same. Really the impetus for the call here is based upon what we're seeing going on with a number of the guys in our book, in terms of veering off of optimal coverage recommendations. And it's our strong suspicion that the folks that haven't yet figured out that they're perhaps engaged with the wrong hedge advisory services instead of MCT, guys in those books might as well be in a similar situation. So we have what we refer to at MCT as an optimal coverage recommendation. And so it goes by different names depending upon the service that you subscribe to, but in all cases, it's intended to suggest an appropriate level of coverage that's going to keep the lender's pipeline in a market neutral position and protect them from market swings. Over the past several months, again, we've seen a number of our clients opt to veer off of those recommended levels. And there's some pretty obvious reasons why. These are lenders that historically have subscribed to a pretty conservative hedge philosophy, but in the current environment, they're deviating from that norm. So for one thing, obviously the lenders that are astutely following the constant messaging coming out of the Fed, which has been pretty unambiguous in terms of their commitment to spare no resource in their efforts to keep rates low and volatility under control. I guess you could look at that and say, hey, if rates are going to be low, why do I want to absorb the costs of a full coverage against a sell-off? Secondly, many lenders obviously remember the carnage that we all went through in the second quarter, where the broker-dealers were pretty swift and heavy in their enforcement of margin calls into the rally. So with pipelines as swollen as they are currently, full coverage against those pipelines can put the lenders in jeopardy of a significant cash crisis, and if that scenario was to play out once again. And then finally, and frankly, there's a lack of adequate line space for many of our lenders with the broker dealers to cover the massive pipelines that they're carrying into this unprecedented market boom. The broker dealers, are contending with limited capacity themselves, and so in terms of doling out that space to their clients, it's becoming an issue where frankly the lenders are looking to even if they wanted to be appropriately covered, have to make a decision between carrying that full coverage or potentially shifting some portion of the production into a best effort commitment. The problem there obviously is that the best effort spreads in recent months have been terribly significant, much to MCT's pleasure, strongly emphasizing the value of actually carrying loans through a hedge and selling on a mandatory basis. That coupled with the fact that if you're a mandatory lender, particularly in this environment, with the BE spreads blowing out, and as Phil was alluding to before, a defensive posture on the part of the investors with regard to BE locks coming in that could be broken, they tend to push back the pricing models that a lot of the mandatory delivery guys are on. So that BE mandatory spread becomes even wider in an environment like this, which again, it's hard to leave money on that kind of money on the table. So that alternative doesn't seem to be plausible for many guys. So all of this adds up to a situation where many lenders are now left in a position with significant exposure, if there was some sort of a market swing, and that's really the impetus of this call. And so we feel the need at this time to reiterate the importance of managing to recommended coverage levels or to keep your position market neutral. MCT always would recommend market neutrality even in a normalized environment. But heading into year end, with this degree of material volatility that we're now facing, we feel that it's more crucial than ever. So why is it that now is so significant? Obviously this is a election year, but it's different than most. It's one of the most polarizing elections in history, to be frank. You got your competing tickets here. which differ on several economically impactful issues. About a month back, there was tremendous indecisiveness in the markets as they were anticipating an extremely tight election. It seems, for now at least, that the stock market seems to have settled down as that lead seems to be leaning towards the Democrats and Joe Biden. The scenario of a too close to call election seems to be silencing a bit, but the volatility index for the bond market, which is known as the ICE or the MOVE index, which is similar to the VIX index for the equity side, has actually spiked on that news. And that's because it's kind of wrestling with the concern that the Democrats could unleash a huge stimulus package if they were to gain power to do so. And that massive stimulus package could very well drive up the bond yields as it would be deficit financed. So that's got the bonds more sensitive or showing higher concern over volatility. There's also concern that the election outcome itself could be delayed or thrown into the court system. So Donald Trump has been pretty vocal on his criticism over the extensive use of the mail-in ballots during this election. And when asked if he would concede a loss if the count seemed to be getting away from him, he's indicated that he very well could take things to the courts. So that adds an additional layer of volatility. Not only is the presidency up for grabs at this point, but there's a market expectation baked in that we could see a significant shift in the balance of power in Congress as well. And as I mentioned a second ago, there's a lack of clarity, frankly, on when or what the next stimulus package is going to look like. Congress has been so distracted with other contested issues, I guess most significantly is the fight over the vacant Supreme Court seat, that it seems nearly impossible for the two sides to come together and agree on the best course of action with regard to the stimulus. All the while, obviously, we're in the midst of a global pandemic. There's a very real possibility over the next couple of months that we could see some sort of a vaccine or treatment breakthrough with an announcement that could obviously impact the markets. And then on the flip side, as we roll into winter, coupled with the government's reopening on social services, many are expecting that we could see a spike in cases, and that could force an about face or a rush back to some economically paralyzing shutdowns or closures. So both of these scenarios have the potential to significantly disrupt the markets. Again, all of this is happening while we're in the midst of the re-implementation of that 50 basis point adverse market fee. So just lots and lots of noise that's in the current economic environment. But good news seems to be that the Federal Reserve continues to project their commitments to supporting a quantitative easing policy and their attempt to hold rates down and dampen the volatility. So in the long run, the prospects seem to be very good for mortgage lenders. But even with that said, it's highly likely that we could be in for a bumpy ride over the next couple of months. So in the short term, we're anticipating volatility and do see several scenarios that can result in dramatic swings one direction or the other. And so that's really what we're focused on here today. So I had the pleasure of being assigned kind of the doom and gloom role in this presentation. So the good news is that MCT has several recommendations on areas to focus on and things or measures that can be addressed or taken in order to help mitigate this issue with the volatility that we're describing. So with that, I'll pass it over to Andrew Rhodes, and Andrew's going to run through some of those recommendations.
Yeah. Thank you, Ben. And I don't think it's all doom and gloom. I think, it's just making sure everybody, prepares for, the potential of volatility. Like we all hope that, there's not going to be a lot of volatility during this election cycle, but we also want to make sure that we're, taking all the precautions necessary in order to, provide the best outcome for our clients. So, a couple things that we, touched on our kind of initial go around with this on the client exclusive webinar was to kind of make sure that you're pricing in those known factors. So essentially, what we're trying to do is we were trying to get ahead of this refinance, the adverse market refinance fee coming and hitting our client's bottom line. So, we were trying to make sure that they were putting that price in their upfront pricing on the front end to make sure, they were ahead of the game in kind of limiting their overall exposure to having this hit their bottom line. So, our recommendation was to implement it as soon as possible. There were some investors out there who kind of introduced that on a tiered schedule. I'm sure you guys are all aware of it. And now, I think all the best effort investors out there have that hit already implemented. We're starting to hear from mandatory investors on their implementation of it. It seems like most of them are going, with having the loans purchased on their side prior to November 15th. Or I guess after November 15th is going to get hit with that additional 50 basis point fee. So the agencies currently aren't going to be implementing that until loans purchased on December 1st. But all investors need time in order to get the loans funded on their side, repackaged, and then sold off to the agencies, which is why we're seeing, the aggregators come out with this kind of conservative time frame on when that fee is going to be implemented. So just trying to reduce the kind of exposure, the unneeded excess exposure during times of volatility. The next data point that we covered was just kind of reviewing and updating the forecasted pull-through. So I know Paul will be going over this a little bit later, but this is paramount in our hedge model is making sure that we have accurate pull-through numbers in the system, so we could get a proper forecast on your expectations, for the loans that are in the open pipeline. So by doing that, we're reducing, also trying to reduce as much noise as possible to ensure that we could provide, accurate analytics during this time of increased volatility. So I think from a best practice standpoint, we're taking a 3-month window, look back period to define, our current pull through, and then modifying the assumptions in the model to make sure that they're in line with those pull through expectations. Now, if you're looking at a longer pull through, look back to make sure that you're taking certain times of excess volatility into account as well, or removing those data pieces from the analysis, because I think a lot of clients' pipelines that if they're looking back over a year, I think they're including a lot of noise, especially with what happened in March and April, with market pull through, investors pulling in and out, broker dealers cutting off lines. There's a lot of excess noise going on during that time frame. So, that's why we're kind of limiting the look back window to the more recent, production and the more recent performance of the pull through. And that kind of ties into, just being vigilant on staying close to that optimal coverage. As Phil alluded to earlier, this is, one thing that we're talking to all of our clients about is, staying close to that optimal coverage. Some clients have been long, just going kind of with what Ben was talking about, how the Fed's going to be in the market until the end of 2022, keeping rates low. So a lot of clients are kind of not wanting to take on that additional hedge cost, but I think it's important that during times of volatility, we need to make sure that we're on top of coverage. And I think the optimal is defined by those pull-through numbers in our the forecasted pull-through numbers in the system. So I think you need to make sure that you're up to date on your current forecasted pull through in the model, and that you're keeping close to optimal to minimize your interest rate exposure in this market. Another thing that Phil talked about, and I think it's important because we have seen it come from a couple different investors, is to make sure that you're following through on your best effort commitments, and not just using those commitments as just there, and then you're going to flip it and sell it to a mandatory investor once the loan funds. Because we are seeing a lot of clawback from these best effort investors, and I mean the reason for that is appropriate. They're taking on the hedge for that best effort lock, at the time of at the time you're committing it. So they're on the hook for whatever that market exposure is, just like you would be on the hook for it. So the reason that they're kind of coming back to you is definitely a known reason, and it's understandable. So keep that in mind whenever you're looking at taking out best effort locks, that you're planning on fulfilling those with the investor that you've been locked with. Like as Phil said earlier, they are tracking that through MERS, and are reaching out to clients to get reimbursed for any of those loans that do get sold out to the market. I know Ben talked about the broker-dealer capacity. I would say, right now is probably a tough time to get added lines, but I don't think it should stop you from getting those excess lines. I think, right now we're seeing a lot of dealers kind of close to capacity and not really adding a lot of extra coverage. So I think the more dealers that you're set up with, I think you're going to be able to handle lock production down the line a lot easier. So in the instance that we do see a rally from here and start going down to that 1.5 coupon and kind of signal another potential refi wave, you guys will have everything kind of set up to handle the new production that could potentially be coming through. So next up is limiting the unnecessary coupon cross hedging. I think this just goes to limiting your basis risk on the hedge. If durations are shocked up or down, that doesn't really affect the hedge. But what does affect the hedge is if there's a compression of the durations, or an expansion of the durations between the two coupons, that could lead to some additional hedge cost, and we just want to limit that exposure as much as possible, right? I think that's the biggest thing, is trying to limit the the excess exposure where we can during these volatile times. So that's why we're kind of recommending to kind of get that coupon coverage back in line. And then going into execution, we've always pushed the bid tape execution. I think that is a great benefit to all of our clients. You get better execution by delivering through an AOT kind of execution, but then you also have the opportunity to streamline your cash flows as well, and you're kind of minimizing your broker-dealer exposure in the same instance by having that exposure on the trade side transferred into the loans that are being purchased. So it's just trying to figure out the best ways to maximize the profitability on the loans that you have, which is what we've always told our clients. Like we want to make sure we're getting the best price for that loan, whether that's best efforts, mandatory, AOT, or any other outlet. So this next piece is going over the purchase turn times for these investors. If you have some investors that are lagging 2 or 3 weeks to purchase loans, make sure you're keeping that in mind when you're selling to these investors. This is kind of contrary to the last statement I made in terms of the best execution, because if an investor is, better, if one investor is better than another investor, but that investor is taking 3 or 4 weeks to purchase loans, then I think that it probably makes more sense to sell to the second best investor, as long as as long as the execution isn't too far off, and as long as the second investor is purchasing on a quicker basis. So definitely want to keep the investor purchase times in mind, especially right now, with most of these guys cutting off that 50 basis point adverse market refinance fee on around the middle of November. Next up, liquidity is king. I think what we're talking about there is having available cash on hand will allow you to navigate times of volatility a lot more easily. So for our clients that had a lot of cash on hand during the March and April months, they were able to kind of navigate that a lot easier than some of our clients that don't have a lot of cash on hand. So it still hit everybody, don't get me wrong, but the guys that were able to have more cash on hand, I think we're able to kind of get through that period of time a lot more effectively. And then this next point is going into, pretty much I would just implement this, or I would try to implement this, prior to the election. And I'm not sure if it comes with a formal policy or, the best way to kind of implement it, but we'd want to reduce any aftermarket hour locks, over the election. So just not allowing any aftermarket locks or after our market locks, for November 3rd, and then you could bring that back November 4th. So just trying to limit as much exposure as possible, like I was saying earlier. Increased margins. This is something that we've actually been kind of harping on, going back to the end of February. And it's a hard thing to do. I know it's a tough thing for a lot of secondary people to do, but it does kind of help with the it helps with the bottom line during volatile times. And it is additional risk that you guys are taking on as a mandatory seller. You guys are taking on that interest rate exposure, so there is some additional risk that you guys are taking on that should be compensated for. So and that's kind of why we tell people to increase the margin during these times of volatilities, and other investors are doing the same thing. So just I think it's prudent for our lenders to manage that, to reduce their overall risk. And then I think the last thing on this list is the active communication. I think this should always be something that that secondary is doing, is talking to the traders, talking to their lock desk, making sure that everybody's on the same page in terms of the policies and procedures of the company, and then also any new changes or anything that the company needs to be on the lookout for during these times of potential volatility. So I think the overall idea of this is just to try to safeguard your bottom line as much as possible by reducing your exposure where you can. I think in increasing the margin definitely helps out with that. Not always possible, but something that I think should be done, especially with this expected volatility. So
Andrew,
I guess,
Andrew, we had two questions come in while you were sharing those best practices. I just wanted to bring to your attention. First of all, Chris asked if you could talk a little bit about the spread between the 10-year and the TBA's primary and secondary rates. There still seems to be some fluff in the aggregators' rate sheets, whereas the 10-year has crept up. Pricing has stayed pretty stable.
I would say the looking at the primary and secondary rates in the market, like going back to March, I think it was actually close, probably end of February, beginning of March, we were seeing some pretty pretty tight spreads. And then after I think middle of March, going into the end of March and April, that just completely blew out. A lot of our agency sellers or agency aggregator sellers, kind of pivoted to just selling directly to the agencies because of that spread, just diminishing so much. We have seen that come back. I think we started to see it come back towards the end of May and into June, but I think it's definitely inflated from where it's been, where it was at the beginning of the year. I think even right now in the environment that we're in, we're still seeing that inflated, and I think it could just be that there's that we're always getting thrown curveballs, so they're not sure, what's the next shoe to drop. So that's probably why they're keeping a little bit of the margin in their pricing and kind of keeping that keeping a wider kind of primary and secondary rate in the market. So I know that we have seen, recently, last couple of days, we've seen an increase in the yields, which kind of, from the commentary that we've been hearing, it kind of leads us to believe that the bond market is starting to price in some fiscal stimulus prior to the election. I'm not sure. I don't know if it's actually going to go through. I don't know if it's actually going to happen, but it does seem that the bond market is starting to price in some fiscal stimulus before the election.
Hey, just to add to that, very similar to all of the originators that sell to them, the aggregators have to balance capacity with pricing to some extent. So in other words, if they pass through all of what they see on the primary side in terms of their pricing, and they get over their skis and their performance, frankly, is impacted, they can't buy loans quickly, then it's problematic for them. So they pump the brakes, if you will, or it's a little bit of an artificial. They'll widen margin just to keep production coming through at a tolerable capacity or manageable capacity. So again, with volumes where they're at, everybody is managing to it. So I think as things subside, you'll see that spread come back in as well.
Yeah, no, Ben, that's a great point. With everybody's pipelines being swollen, as you referred to earlier, I mean, everybody's kind of at capacity, or I think we will see though that spread kind of tighten up when we don't have so much excess capacity or excess production in the market.
That's perfect, guys. Thank you very much for that. And we did have one more question from John, who asked, this may be tough out of context, but are you suggesting using UM30 and Ginnie 30 3% coupons?
Yeah, no, it's a good question, because this goes back to the reducing basis risk by kind of limiting your cross hedging. I think we're kind of at an interesting market right now with the compression that we've seen on the higher coupons. Because I mean, you're trading at I think we're 9 ticks between the Fannie 2.5 and the Fannie 3 on the front month. So it's not a bad question to ask. I would still feel, in that kind of scenario, I would still feel like hedging with the 2.5 for the 3 coupon production, it isn't going to kill you. I think you're at a limited kind of with those higher coupons on the kind of more cuspy side. I think you're seeing, kind of more the durations are kind of in line with those securities anyways. I think the majority of the cross hedging that I'm concerned about is on the lower coupons. primarily the 1.5 and 2 and 2.5, I guess, because the duration difference between the 1.5 and the 2, I think is close to 200% right now, and the same thing between the 2 and the 2.5. So there's just a lot of extra kind of, I guess there's some extra capacity for those ratios between the coupons to expand and contract. Whereas on the higher side, the 2.5 and the 3 duration, those are actually more in line. So I think those are close. Truly, I think they're close. If not, the 3 might be a little bit more than the 2.5. So there's just not as much noise going on with those higher coupons. So I think you're still okay to hedge the higher note rate production with the higher end of the coupon range. But it does kind of bring up a good point, because I bring up the Fannie 1.5 because we're thinking that there might be some Fed intervention, and the Fed might drop down to start buying the 1.5 coupon here with their next schedule update. I think that's coming out on the 28th. So something we're going to be keeping an eye on. We're currently not trading a lot of that Fannie 1.5 coupon, but it is out there, and I do think that we're going to see a lot more people using that as a hedge, especially for those note rates of 2 5/8 down to 2 1/4. So
Perfect. Yeah.
Okay. Well, I mean, with that, I guess I'll hand it over to Paul and let him kind of do some walkthroughs on MCT Live.
Perfect. And just for the people who submitted questions, thanks for that. And if anybody has questions as we go along, feel free to shoot those into the chat, and we'll keep the answers coming. So thank you for those answers, Andrew, Ben, and take it away, Paul.
Thank you, Ian. Yeah, so I just wanted to cover some quick, functionality type items here in MCT Live that are available to our users and to our traders that trade on behalf of our clients as well. Just if you remember the bullet points that Andrew just went over, I'll cover those in some order there. First off, if you in his first bullet point, to talk about that adverse market fee. Effectively, as those refis come in that don't have those hits, and then as you're applying those hits, essentially those clients, those borrowers, the locks at whatever status they're in, their pricing is essentially 50 basis points worse, even in a flat market. And so with that being said, if you remember in some of our earlier webinars, we in release notes, we introduced this idea of applying that 50 basis point market reduction, and then also applying that as a market diff based on lock date. So if you were to suggest that anything locked prior, if you implemented that adverse market fee of 50 basis points on the October 22nd, anything locked prior to that is essentially has a 50 basis point market reduction, and therefore their pull through would go up. So that's a good way or a good example of how to manage that pull through based on those outside factors. And yeah, we probably think that that won't be it's certainly not the first kind of hit that we've seen from the FHFA, and probably won't be the last. While we're on kind of the pull-through assumptions, I'm going to revisit pull-through assumptions and that forecasted pull-through idea that Andrew harped on pretty good in the last section there. This is where we kind of see you would adjust your pull-through in here, and we can go through our pull-through analyzer here in just a bit to validate some of these numbers, help us validate what we're looking at as far as these assumptions go to calculate a forecasted pull-through on your pipeline. But before I switch over there, talk a little bit about the idea of maintaining your coverage close to optimal and looking at that, seeing how much you are potentially cross-hedged. from a real high level, it's very easy to see if you're in MCT live, if you are close to optimal coverage. We deliver it very plainly here, as here's where we're recommending you be covered, and then you can see your actual duration adjusted coverage here, and then we do the math for you to show you if you're long or short. You see that by coupon, and then again by in aggregate here. If, again, high level, if you want to see how much of a crosshead you have on, it's simply just don't want to get too much in the weeds here for this call, but you can see the difference between coverage and nominal just to see how close those are, or how far apart they are. It may be a sign of too much of a crosshead. But if you scroll down here, you can see your coverage broken down by coupon as well. So this is where, John had the good question, and Andrew said, what should I be hedging with my 3s to 2.5s? And this is where you can kind of see the differences, where your production lies versus where your hedge position is. And you can see if you're cross hedge. You can see here that we're 3 million long on these UM30s in the sample account, but that's duration adjusted, obviously. But on each coupon, we have differences here. This is where you can definitely quickly tell if you're cross hedge and make sure that you do have the appropriate amount of coverage on in these twos. And then, as Andrew mentioned there, as we possibly move down into more liquid 1.5, which is crazy to think about on a 30-year fix there, then this range would be adjusted in MCT Live, so you can see that as well. Purchase times, want to touch on this real quick. It's like we mentioned, just sticking with your investors that possibly not only best execution, but that can purchase those loans rather quickly. Unfortunately, we do have some potential risk for forbearance. So purchasing loans, getting loans purchased quicker, the better. So you can kind of eliminate that, minimize that time a loan could go into forbearance while the loan's on your watch there. And so purchase times, you can come in here and see an investor purchase report and see it broken down by investor as well. Average days to purchase. Now in MCT Live, we measure that as from commitment date to purchase date, so keep that in mind too, that it's always beneficial, which most clients are doing a great job of getting that package right out the door after commitment. So it's same day or within a day or two after commitment, but keep that in mind that you can quickly see your average purchase times here. Okay, let's get into PT Analyzer here. PT Analyzer and MCT Live, let's remember this is kind of a live look back of loans that have exited a hedge. So a live analysis on loans that have exited the hedge, whether they've exited the hedge as a funded loan or exited the hedge as a fallout, prior to funding, obviously. We mentioned kind of looking at loans or minimizing the date look back. Obviously 1.4 billion, for some of us have had quite a big volume spike over the last few months. That's a drop in the bucket, I guess, but this is still kind of a widened timeline. So if we wanted to minimize that timeline, let's say we want to look back 90 days. Remember, when you're looking back at pull through, you want to take into account that you still have loans in the pipeline as well. So when you're looking back, make sure you back up the end date, possibly 30, 45 days, whatever your average lock period is. That way, you're kind of taking into account the fact that you still have loans in the pipeline that haven't been a part, that aren't considered a part of this analysis. So you want to back up that end date. And then if you want to go 90 days from that, let's say we go to 6/18, which I believe is about 90 business days. And then we can just do a quick analysis on that date, and you can see here what your pull-through is by status. So we've got this pull-through ratio column here is going to show us that pull-through by status there. Now this is great, right? But you want to compare this to your actual assumptions just to make sure you're right on. So this client here, sample client here, is doing pretty well on this initial lock status. You know, the loan hasn't been submitted to underwriting or processing or anything like that yet. We're kind of right on top of the money there if we look at our forecasted pull through. And then if you look at your unadjusted pull through here, your zero market assumptions, you know, pretty close there. And then you can go down in each status and kind of validate if you need to make a change. You know, right here, this could you may have a case here to where you need to drop your forecast or your pull through assumptions for underwriting received loans based on looking at this. So looking at this can kind of help you dial in, make little tweaks here and there to your assumptions. By doing this, or looking at the screen, you can also drill down and get as granular as you want. So I was looking at a very high level with only a date constraint in there, but now I kind of drill this down to con 30s. I can look at this on just govies if I wanted to, but then I can also look at this between purchases and refis. So that way you can really spend the time in here to try to drill down to what your your last 90 days of pull through have been, and try to let that influence your future assumptions there.
Yeah, Paul, and those are great points, and thank you for touching on that endpoint of the analysis period, because that does make a big difference to exclude loans that are in the open pipeline by kind of backing out your average lock term. So yeah, no, it was a great point there.
You know, the last comment I'll make, and I won't spend much time as going through the actual functionality, but remember on you know, maximizing those executions in our best X analysis, we'll make sure you're looking at best effort production, and if you see a lot of best effort pricing and you're having those capacity constraints at your broker dealers, maybe take advantage of that a little earlier, relieving that capacity issue. But then also taking advantage of those AOTs. Remember, as a single platform, it's very easy for us to assign trades in MCT Live. So it's a no-brainer to try to take advantage of that for cash flow purposes, and also and helping you relieve your those dealer lines so you can take on more volume. And therefore, if you are moving down in coupon, right, recycling the trades is always good. We preach recycling the trades here at MCT, but if you are moving down a coupon, like we said, that cross hedge can burn you if we have tighter compression, or if we just have a big shift in that where the market rates are. And so by doing those AOTs, it gives you the opportunity to rebalance that coverage as new locks come in. So yeah, just to recap, remember looking at your optimal coverage here, using the tools available to you wherever they are, like a PT analyzer tool here in MCT Live, to kind of make sure you understand what's happened to your pull through in the last 90 days, and looking at those, analyzing those dealer lines. One thing I'll mention in here, not a great example here, but you can see on our master trader blotter, we do have, you know, a view into what your availability is at your dealer, so you can kind of see how much volume you have. If that was ever in question, you can come in here, also run a full dealer analysis if you're looking to see how close you are as far as your mark-to-market limits, or even your volume limits. Ian or Andrew, do we have any other questions or anything else we need to go over here?
One client or one participant asked if this was a client or a sample dashboard you were using, Paul, or data rather. Yeah,
great question. This is actual volume and trade information, but kind of sample. This is it's kind of mirrored off of an actual client.
Cool, perfect. All right. Well, with that, we've reached the end of our scheduled programming here for the webinar. So if anyone has final questions, throw those in the chat now. We do thank everybody for joining us here today for our first Zoom webinar. I got to say it went pretty smoothly, and we're so excited to have those of you who will be participating in MCT Exchange. Will be using this platform in just about 3 weeks for the virtual conference. So it's going to be exciting. I don't see any further questions. So Paul, Andrew, Ben, Phil, thank you so much, and we'll look forward to talking to everybody soon.
Thanks, guys.
Thank you, guys.
Thanks, guys.